Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. Hello again, everyone, and welcome back to mine and Tina's Property Finance Explained series of videos. So we all know when we go to buy a property that we need a deposit. So Tina, explain to us, what is a deposit? How much do we need? What's involved in order?
Okay, all right. So I guess let's break it down back to basics. If you are buying a property, generally speaking, there is a purchase price that you need to come up with the money for. In addition to that, there will be costs attendant to the purchase. Now, depending on where you're buying, whether you're a first home buyer, whether you're an investor, generally we need to cover off costs such as stamp duty, legal costs, some bank fees, whether there's a buyer's agent. So as a general rule of thumb, you need to allow for around 5% in addition to the purchase price to cover those costs. Now, I'm just going to leave first home buyers to the side for the moment. We can cover off that shortly. Okay, so in addition to having the costs covered, so that 5%, with the purchase price, the preferred lending guideline for any lender is 80% of the value of the property. So if you're buying for $1 million, that's an $800,000 loan, and that requires a 20% deposit plus those 5% costs that I was talking about. Okay. Now, where that came from, essentially, the banks have looked at the history of time. If they had to step in, sell up a property, go to the market and foreclose, how much of their money are they going to get back? And they deemed that 8 cents to the dollar is essentially a reasonable figure for them to feel comfortable, and then they're not going to be in a loss position. Now, over time, that figure has probably actually risen, but it's stuck. Okay, so if you can actually get a loan for more than 80%. However, to do that, essentially the bank wants to cover their position by taking out insurance, whereby, and we've heard the term LMI, lender's mortgage insurance, and it's basically an insurance premium that the bank takes out on you that you pay for that covers them in the event they sell up your asset and they don't get back all of their money. They're able to claim that difference from the mortgage insurer.
So you're paying for the privilege of not having to come up with that full 20% deposit, and you're covering the bank for the risk that they're taking.
Now, so there are some banks that will go up to 85% without that mortgage insurance. There are other lenders that, based on certain professionals, so doctors, lawyers, there's a few others on that list, depending on the lender, they might let you actually borrow up to 90% without that mortgage insurance. Okay, and that's because that bank has taken a risk that that profession essentially is highly unlikely to default. So they're prepared to go to that loan amount without that insurance. Okay. In terms of what first home buyers, for example. So depending on where you are, in terms of, we're in Australia at the moment, so whether you're in New South Wales, whether you're in Queensland, every state will have different rules around stamp duty, what the threshold is, what the eligibility is, what the criteria is. In addition to that, some states will have what we call a first home buyer's grant, whereby if you're going to live in the property, generally speaking, it's for around 6 months within the first 12 months of the year, then you may be eligible for a first home buyer's grant as well, which is basically some cash back at you. Okay. More recently, the government implemented a scheme whereby they would actually become the mortgage insurer, allowing you to not pay mortgage insurance and to basically buy a property up to a certain threshold, and therefore reducing the amount of deposit that you have. Okay.
Yeah.
Now, the thing with these schemes is they change rapidly. The availability of this first home buyer scheme,
limited
they release more
places.
places.
Yeah.
So, and again, if you're purchasing at the higher level, generally those schemes don't really apply. They have those price points which
and they're aimed at obviously the low price points where they're assuming the first home buyers, those are entry level price points, which I think is fair enough. Yes.
So that is definitely worth exploring if you are a first home buyer, particularly for an owner occupied property.
So if let's assume you're not a homeowner, first home buyer, sorry. And there could be situations where paying LMI is worth it to preserve cash, for example. Some people use as a bit of a strategy. So tell us a little bit about, when paying LMI is worth it, really.
Okay.
Is it worth it just to get into the market?
Okay. So typically speaking, people come to me and they say, we've got this much money, we earn this much money, these are our expenses. How much can we borrow? How much can we buy for? So the thing that we look at is borrowing capacity, which is what we talked about in our previous video. But in addition, how much cash do you have? And it's very common that, particularly in Sydney, for example, if you're renting, which is expensive, and living in Sydney, you may be professionals, you may have good, strong income, but your ability to have saved a significant deposit it may be limited. So if you believe, so you have two options. You can essentially go back and save up more money so that you have this bigger 25% deposit, or you can look at potentially using mortgage insurance to enter the market sooner rather than later. So when do I recommend mortgage insurance, or when do I think it makes sense? If the time it took you to go away and save up that extra money was going to take that much time, that in the meantime the market has continued to go up and up and up, and then when you come back and see me, that depositing has increased to the level where you then got to go back and save again and again and again. So you end up chasing your tail, and it can get to a point where if you look at the mortgage insurance cost, get into the market, and it's over the 30-year life of the loan. In that situation, it can absolutely make sense to me. If you're a person that's decided to rent best, which, rather than buy an owner-occupied property, you'd rather pay rent, live wherever you choose to live, and want to have that ability to move around depending on life and whatever it throws at you, and want to buy investment property after investment property after investment property. Again, if you've saved up enough deposit to buy one property and potentially want to buy two properties, but you would then have to keep saving and risk the market going up and up and up, using some leverage or going up to, say, a 90% loan, including the mortgage insurance, might enable you to buy two properties, for example, or be fast track onto that second property or that third property.
And I would say also, and then you're using less of your precious cash to put it into an investment property with the loan on which is tax deductible. You can save that cash to then perhaps put towards an owner occupied property that you might buy, in a few years' time, I guess. And,
there are situations where some clients have the cash for a 25% deposit, but they choose to keep some aside so that they can buy a property that is just slightly more, which perhaps has a better risk profile for them in terms of their requirements and objectives. And they decide to actually pay the mortgage insurance, keep a bit of their cash as a buffer in case something goes wrong, or in case they need to spend a bit of money on property, or if they're without a tenant and so forth. So it can be a bit of a risk mitigant strategy as well.
Yes. So I think the moral of that story is that it is worth considering. I think there are people out there who are very staunch. No, I'm not paying LMI. I'm not paying LMI. I think there is a case for it, as you've explained fabulously. Talk to us a little bit downsides of that LMI scenario.
Right. Mortgage insurance has a cost. So, people often
Not
don't
cheap.
pay.
Yes.
But in addition to the cost, it can often mean that the interest rate that you pay on that loan is a bit higher.
Yeah.
Okay. So that is definitely something to consider. Generally speaking, if the property goes up in value and then eventually you get to a point when you're under 80%, then you can look at potentially refinancing and getting a lower interest rate. But the flip side to that is, if for some reason you did want to refinance that loan, you can potentially have to pay mortgage insurance again if it's still over 80%.
Yeah.
And your leverage when it's very common for me to go back to the banks for my clients and ask them to give a lower rate, particularly when I know the market has reduced.
Yeah.
But if they're in that mortgage insurance territory, it's very easy for the banks to say no, sorry, because they know that they're going to need to pay the mortgage insurance again.
Yes. And it's actually, personally speaking, just a little personal story there. I bought a property maybe 5 years ago or so using LMI because I didn't have literally for an investment property, I didn't want to spend the full 20%. And that has now grown sufficiently for me to be able to negotiate a better interest rate, on that loan, because it's grown in value. They've looked at it, they've gone, oh no, you're good now.
So you're a refinance risk now is basically what they're asking themselves.
That's right. Yes. That is how I positioned myself, in fairness. It was like, come on, guys, give me a better rate. Okay, so any other points then, Tina, about sort of deposits, LMIs?
Probably the key one.
What other options do people have?
Yeah, I'm hoping this one changes, particularly in the bigger cities. But once you start to borrow more than $1 million in mortgage insurance territory, it gets much, much harder. So there becomes limited lenders that actually participate in that space. The ability to negotiate better interest rates on that reduces as well. And it just becomes a harder proposition all around. You need to tick a lot of boxes. And when you're only dealing with a small handful of lenders, it just opens up a bigger risk in that I always feel more comfortable with a client when they're buying and negotiating on properties, particularly at an auction, for example. If I know that if I have an issue with a valuation, I can go to lender number B lender C as well. So that's just something to be mindful.
And what other options would somebody have if they, in terms of getting their hands on a little bit more cash?
And look, probably something that's very, very common, particularly for my client base, is some kind of parental assistance. If you looked at the stats, it's very common for family loans, family gifts, parental guarantees. Now that's probably a whole nother video which we should cover off. But definitely explore what profession you're in, making sure that there's no LMI waiver for you, and explore the options of parental guarantee as well.
Okay, well, great. Gosh, that is a lot just about deposits, lenders, mortgage insurances. There is a lot to consider. I think there are many morals of our stories there, but I think it's if anything is clear from our whole series, it's so important to talk to someone like you, Tina, for people to not just stroll into a bank. There's so many options out there that I think people aren't always aware of. There's a lot of planning that goes into this. Like you said earlier, the considerations for your future of how you do and don't use equity, how you do and don't use cash. So everyone, be sure to give Tina a call, discuss all your mortgage broking needs, and we will do a video very, very soon.
Great. Thanks, Kate.
Bye.
Bye.
I really hope that you found all of that useful. Tina is a mind of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button, and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.